Absolutely delighted to have Marwan from Gama Aviation, Dustin Cordier from StepZero Coaching, Angus Russell from Clairfield International, and Andy Priester, who's just landed in the UK from George J. Priester Aviation. By the end of this panel, Priester is either going to have bought Gama or Gama is going to have bought Priester. They're still deciding at the moment. But it's great. We've got 2 operators, 2 advisors, everything you need to get a deal done. Okay, Marwan, let's start with you. Between 70% and 90% of all M&A deals fail across all industries. Is business aviation any different?
Our experience is different, yes.
So you think the hit rate is better in business aviation?
I don't know. I mean, I think it's a tougher business to do M&A in, but we've probably done somewhere between 20, 25 M&As, and I would say probably no more than about a handful have failed or haven't been as successful as we'd like them to be.
Andy, you've bought 3 companies in the last 5 years. Do you think it's harder or different to other industries?
I personally think it's quite a bit different. You know, I think the emotional factors in a lot of these acquisitions wind up being quite a bit different, and the acquirers and how they're affected by that emotion. I mean, the truth is, we do have from the outside, from people that aren't in our business, we have an exciting, sexy business, right? I mean, it's one that what we do is one of high profile and notoriety. So there's a lot of people that don't understand the fundamentals of our business that are interested in getting in our business. So sometimes that skews, you know, their perceptions compared to other businesses. And I also think those people that are looking at representing their companies or looking to get investment capital, they can get really creative with data to really try and you know, lure investors in. So I do think it's quite a bit different.
Angus, you've got one fantastic client who I know you rate very highly in this sector, sitting on your left.
Which one's that?
And you do other sectors. Do you see business aviation as different?
Yes, I do. I think it's probably harder than other sectors. I think probably because the underlying business is more vulnerable when it changes hands. And I think, I mean, so much of what you do is based on client relationships, and those are vulnerable when companies change hands. So I think, I mean, one of the other questions I'm sure you're going to ask is how do you get it right? And I think just really making sure that you incentivize the people and the people that manage the client relationships to keep them there.
Dustin, you've had a varied career. You've been a pilot flying into North Korea. You've been an aircraft broker. And now you've set up a shop to specialize in helping entrepreneurs exit. Really, do you think it's different?
Well, I think one of the main differences is it's an industry where the buyer doesn't necessarily know what they're buying. Where it's a lot clearer in other industries. Are you buying a relationship? Are you buying a cash flow? What exactly are you buying? So the diligence period can focus on very different things depending on what the buyer thinks he or she is looking for.
Marwan, would you agree with that? You've been a buyer and a seller. I remember having dinner with you just after you'd sold Jet East, and your poor CFO was asleep, but you were in great mood.
I think you touch on a very valid point, but I think you do have to know what you're buying for, whether it's capability, whether it's scale, whether it's cash flows, and so on. So I think it's a very, very important thing to kind of go in there with your eyes open, knowing exactly what you want out of the deal.
Andy, you're tending to buy family companies. That's what you've been working on. Yeah, and I think Angus's point about the relationships really interesting. How do you keep that?
You know, it's a great question. What we do with the acquisitions that we have is is a bit non-traditional, and that is we actually go and sit down with the aircraft owners that have the relationships with the principal that we're doing the acquiring from, and together share with them the vision of what could be, so that they're on board. And so far, we've been really, really successful. I completely agree with what Angus said. I mean, it's a relationship-driven business. Our personal strategy is to, find opportunities through acquisition or partnership to really lean into the legacy relationships that those companies really had, because we think that's critical. The truth is, on the management side of things, I mean, what are you buying? 30-day contracts, 60-day contracts, 90-day contracts? And it can be, the other word, I don't remember who said it, is that, I mean, it can be a very vulnerable transition. And quite honestly, I think our industry is littered with the companies that didn't realize that proved to be unsuccessful when they did these acquisitions.
Dustin, how do you value a management business when you've got a 90-day contract?
Very carefully. So checking under the hood is very difficult in an acquisition because you're looking at really two different businesses. You're looking at the operator, and you're also looking at the owner. So the operator has a mixed stream of revenues. It could be a per hour revenue, it could be a per flight revenue, it could be a per month revenue. So you have to discount those cash flows however you're going to do that. And then on the ownership side, the interest cost itself could wipe all that other revenue out. So really it requires an extensive diligence period that requires a lot of planning ahead of time.
Angus, you also don't have a lot of comps in this business, do you? It's not like, sadly, one of the listed ones decided to go private. But it's hard, isn't it, to see what valuations people have got? And
yeah, there just isn't a list of precedent transactions you can point to. And I think, if I contrast it with Marwan's maintenance business, Jet East, when we sold that, it's a relatively defined industry with transaction multiples that we can point to. In this industry, there's just a great variety of business models. There's a variety of sizes of companies and margin points and vulnerabilities. So it's tough. And a lot of times people point to multiples of EBITDA. I'm not clear that that's actually the right way to look at these businesses. I think it's really a focus on cash and what's the level of customer relationships that you think you can maintain post-acquisition, and that kind of backfills into what you're prepared to pay for a business.
Marwan?
I think, personally, I see the biggest criteria as a willing buyer and a willing seller. I think that's what drives the valuation ultimately within our sector. And I think once you've kind of worked that out, generally you can reverse engineer whatever matrix you want to justify the deal, whether it's cash flow, whether it's multiple, etc. But you can't drive it with the science of the valuation. You have to drive it with what both parties want to do.
And Andy, that's especially true on the deals you're doing.
Yeah, it is, and to Marwan's point, sometimes the sellers have different motivations. There is plenty of private equity out there that could have gone and bought the same companies that we bought, and a significant factor was they felt that we were going to continue and support and build on the relationships that already existed. So it is not as crystal clear as other businesses.
CGI Miami, Ken Reiki, basically when private equity's on the whole been bad for business aviation. Marwan, you sold your US aircraft operations to a private equity-backed company. What do you think?
Our own experiences, they were very pragmatic, they were very fair, but it's like everything else. They, it was a strategic acquisition for them. You're referring to the maintenance business. It was a strategic acquisition.
And I was thinking about Wheels Up, buying your...
Oh, well, again, that was strategic for them as well. They wanted to buy the vertical that was providing them with services and
Who got the better deal?
I'll leave it to others to kind of judge that, I think.
Andy, when you've bought someone, how do you retain the customers?
Boy, I sound like a broken record, right? If you go back to the very first panel of the day, one of the things Mike in the panel was saying is that they pick operators, they pick management companies significantly by cultural fit. If you recognize that the operating budgets really aren't going to change significantly amongst the tier one operators, it goes right down to, demonstrating to the aircraft owner that you can wind up supporting them with the services that they need. That's the fundamental, that's the ante, and then after that is cultural fit. So if you don't have that cultural piece down, not only for your own operation, but then also as you're looking to acquire or partner with other companies, you have the risk of really blowing up your operation. So to answer your question, you have to focus a tremendous amount of time on maintaining the relationships, both in good times and bad. We're in aviation, right? It's not always gonna wind up being perfect, but if you're a high integrity operator and you can communicate with your owners in a way that gets them to understand the situation, even negative situations, you have the recipe for long-term success.
Here's an impossible question. You're in negotiations with a company, you buy them, and it's all about the soft skills. Well, Dustin, I want you to come in this a second. But it is the culture. Do you reckon you'd lose a higher percentage of customers and employees if you changed the name of the company?
We think so. That's the exact reason why we're leaving the companies that we bought with their names, and then we're bringing the back ends together for obviously the operational efficiencies. But our philosophy is why blow up a legacy? Why with Mayo Aviation? They've been around since 1978. Why do we think that we could plant our flag in Denver and pretend like everybody in Denver is going to think we wind up doing it better? That just winds up being silly. Tell a different story, share with the owners why it's so good and what the vision is, and that they can trust in the relationships that have existed for the last 50 years.
And because Marwan, with Tyrolean, you're still planning to keep the same name, or?
I think we are in terms of kind of a particular brand and a particular service that we want to do. But I agree with Andy. It's there's no one size fits all. You've got to look at each opportunity. You've got to look at the value that the brand has, its location, and how it fits into it. But you do need to align the cultures. That's quite important.
Dustin, culture. How easy is it to align the cultures?
Well, it requires leadership, right? It is, and I'm sure Andy can attest to, an acquisition in the operator world is not easy. It is, not only are you dealing with the customers that you're trying to convince to stay on, even driving down into the technology. Right? Are you going to bolt things on, or are you going to tear things down to the studs and rebuild that all up? And that goes into the culture piece as well. It is a certain piece that you bolted on. Are they keeping their own culture, and it's only a back office relationship together? Well, if so, that's going to have a tough time being sustainable with that. There has to be a unified culture. It requires really strong leadership, somebody that is able to get up in front of the crowd and continuously paint that vision. Where are we going? Where are we taking this thing? Having alignment on the vision, and then providing the tools and resources so that people can execute on that vision.
And Al, if I can just add to that, at least the way we've approached it, Marwan, maybe you did too, we were very deliberate as a leadership team when we brought companies together. And we recognized that we were going to have what we called 30% early adopters. We were going to have 50% wait and seers. And this is on the internal culture, by the way, in terms of our team members. And we were going to have 20% of the people that they just don't buy into what you're doing. Maybe they've been there a long time. Maybe they don't like the change. That's reality, and that's the unfortunate reality. But if you come to grips with that when you're trying to blend cultures, then you can again focus the time and effort on the early adopters and your wait and seers. And then the 20% that are going to self-select out, you can do that more efficiently so the company doesn't wind up getting affected as negatively as it could be if you try and hold on to those people that are going to never buy into what you're doing.
Marwan, you touched on very honestly that not all of your deals have worked out, but you've bought a lot of companies, you've sold a lot, and Jet East was a fantastic transaction for Gama. When the deals haven't worked out, is that because of culture? Is it because of something you didn't know about the business, or is it just bad luck?
It's all of the above. I mean, culture is probably a very critical part of it. If you can't kind of align the businesses, then it's very, very hard. I think, there's probably a couple of occasions where the diligence hasn't been as maybe as thorough as it should have been, and skeletons come out of the cupboard, and that does muddy the waters a little bit. So it's a combination of all of those things, but it's I think the understanding the business and what makes it tick and why you're buying it and what makes it successful is important, and seeing whether it can be aligned. And I think, to Andy's point, the other not everybody within the business needs to stay in it, unfortunately, because part of the challenges might be those people. But I think the same applies to customers. I mean, I know it sounds odd, but particularly in aircraft management, what I find is that when you look at an aircraft management business to acquire, there's probably somewhere between 25 to 30%, a quarter to a third of the business is the best part of it. That normally has the relationship with the owner of the business, but that's the most lucrative part. You've got a section in the middle that's between 40 and 50%. That's good business, and you want to kind of build on it. But there's probably always about a quarter to a third that you really just want to exit out the door, because it's just been business that's been built up to get scale, that's not very good quality of earnings, and it's just really more trouble than it's worth. And you use the opportunity to exit it. I know that sounds odd in a service business to be kind of wanting to exit clients, but unless they're attractive and they pay good fees, then you don't want them there.
And Angus, when you're advising on the buy side, I guess or the sell side, one of the problems is when you're planning to sell, your natural thing is to scale up as quickly as you can in that last few years, isn't it? So you almost by definition are going to end up in a business like this with subprime customers.
I think that's right, but you also need to recognise that you're ultimately going to be selling to probably a sophisticated buyer who's going to be like Marwan and is going to recognise which customers are vulnerable, and so just putting on scale for the sake of it, I think it's going to be seen through. But look, I was quite struck by a comment that Niall Olver made earlier. Actually, I mean, he was asked, I think by you, is Niall he's not in the room anymore. He was asked by you, are you looking at M&A? And he said, well, I guess I need to, because organic growth is just so slow in this industry. So just getting customers organically, you'd probably rather do that because the customers want to come to you rather than buying them. But it's a fact. If you want to put scale on, you're going to have to buy businesses.
Is there also a temptation for a seller to, you're trying to have the best EBITDA you can? Is there also a temptation that to try and cut costs, people costs? It's an obvious one. Try and have your staff working a little harder for the last 6 months, so that when you guys are buying a management business, you often buying them thinking you need to put more resource in, or is it not that strategic?
I mean, I think we need to recognise that this is an industry where there's very big economies of scale, and there's big fixed costs that need to be covered in just being an operator. So scale absolutely matters, and it could well be that your business is worth more to somebody else because they can get more profit out of it because they can leverage their own overhead. So at the right time, I think do think about selling. And in slightly different industry, that's where we were with Jet East. West Star had a bigger platform, and they could just generate more profit from it, and they paid for that.
Andy is going around picking up generational businesses. We're talking about this baby boomer founders getting old enough to retire. Dustin, we've got this across the brokerage industry, we've got this in the operators. Do you think we're about to see a big demographic sort of acceleration of deals?
Well, I mean, absolutely. In terms of baby boomers retiring, I mean, we're talking on the next 10 years. You're looking at a scale that we've never seen before. So that will certainly affect the operators as well. And going back to the point of how you're going to grow, and what is your intention? I mean, you get to 50 aircraft because you want to say we're legit, right? And then you get to 100 aircraft because you want to say we're bulletproof. And then beyond that, you're getting economies of scale that's going on to that. So there will be buyers that have to grow, but the demographics industry-wide and really worldwide is that there's going to be a lot more sellers than there are buyers in the next decade.
Andy?
Yeah, I agree with Dustin, and the nature of our industry is one that you will be squeezed out because of lack of scale. And more recently, if you take a look, and I do think this has to do with private equity and trying to make numbers, you take a look at what some of the major FBO chains are doing and how they're changing their pricing strategies. To the extent you're a smaller operator and you don't have the ability to leverage a relationship to control the cost on behalf of your owners, I think it's going to wind up being challenging. So scale has always been important, but it's even getting more important.
Do you think we're going to get to a point when you're going to pay event fees on non-event days? There's going to be fewer of those than...
Did you say, are we going to get there, or are we there?
Marwan, do you think we're about to see a demographic shift? Or there's also a trend, isn't there, of operators buying maintenance facilities in retirement towns?
I mean,
like Bournemouth.
Yeah, I mean, it's an odd question to ask a dinosaur like me, but I think there will be a slight shift in all of that. I think, I think then, we've just heard earlier about choices of ASCs. I mean, is it a choice or is it, just a cost base? The industry is becoming a lot harder in every aspect that we operate in. And it's just, there is a time where people need to kind of, exit and monetize their investment and move on. And that's what's going to create the opportunity, I think.
Angus, where do you think we're going to see deals in the next 12 months?
Well, I think the industry needs to consolidate. I mean, there are just too many very small operators out there that are pulling down margins, and people have almost got into it by accident, or it's a family business. So I think the industry needs, and I would expect to see just more of those smaller companies being acquired by larger businesses. Whether or not we're going to see a bigger consolidation play, I don't know. You've got two of the players on the couch in front of you. But like Marwan says, it needs a willing buyer and seller. I'd also say that, just to pick up on the point about maintenance organisations, I mean, I think there's some conversations that we're having about operators buying adjacent activities like maintenance or charter broking is the other one. And I think that's also a subsector that needs to consolidate, and some of that can go into the operators.
I would just say, the good news about the demographics, even though there's going to be more sellers than buyers, is that if you are a company that generates reliable cash flow and you can prove that the business operates independent of the owner, there will be a buyer.
Yeah, I mean, I think, going back to the valuation question, I mean, we, if we're all honest with ourselves, I mean, aircraft management business within the business aviation sector is not the most profitable sector. So a lot of the time you're looking at businesses to buy that actually are not necessarily generating a profit at the time. So, if the only criteria is a multiple of EBITDA, then, they'll be paying you to buy them. That's a challenge. But in general terms, you've got to kind of, to some extent, understand really or have a view yourself about what do you think the art of the possible is in terms of kind of the profitability that you can get out of the aircraft that you've got under management, and if you're looking at a business that's not delivering that kind of yield per aircraft, if you like, then maybe one of the opportunities that you buy it, and pay a fair price for it, for what it's delivering today, then the opportunity is in increasing that yield. It's not really in our sector, I think, in synergies. It's in revenue synergies more than it is in cost synergies, and I think that's something that that we've seen a lot of. Good old financial advisors will always tell you, particularly when they're selling about the cost synergies that you can get, but they're really, really hard to extract.
Although in some ways you're looking at efficiency synergies, both of you, aren't you? Where you're both having, which are not necessarily costs, but you're both building platforms that can sort of support, the other parts, the compliance and the regulation, and which is almost like a hotel chain model now, where you guys can have different brands.
There is incremental cost, though, that will continue to accrue as you build and grow.
Do we have any questions in the room? The only question on Slido is ridiculous. I'm just ignoring it. You need to talk into the black bit now.
Into which end?
The black.
Oh, this is a microphone. Interesting. I think the panel's been talking a lot about management companies merging, but I'm just curious, in terms of consolidation, fleet operators that own or lease their airplanes, fractionals, are there any thoughts on which models are better for consolidation or have, just really aren't, applicable to consolidate among the different operating models?
So, Doug, my personal opinion is you can't own airplanes and make money. I'm not saying that's not the case short term, but I believe long term it's very, very difficult to do and very, very risky. I think consolidation amongst those operators is fraught with even more risk for any of the potential acquirers in that particular situation. So I guess the answer is I don't know what the right model is. We're certainly not interested in pursuing anything along those lines, as we kind of grow and expand.
Any other questions? Or Dustin, did you want to say?
No, I mean, the generic answer is really just it depends on what the buyer is looking for and what the seller is looking for in that aspect. I mean, Solaris and AE worked out well for AE. Yeah,
Solaris worked out very well for AE and Dan. Any more questions in the room? We can actually give you a mic if you don't want to catch the ball. Okay, final question. Oh, we've got another question. Bernard, no.
No, we do need to answer the question on slide.
What would Al do if private equity offered to buy CJ? He'd discuss it with Louisa, but we've got an IM ready for anyone who wants it.
You've got a financial advisor right beside you.
Ready? Yeah, I know. If it's a US deal, Dustin can have it. UK, you can have it, Angus. Any more questions? Okay, you guys act on both sides. You've all been through. You've bought and sold. Actually, you haven't sold yet. It's about time you sold, Andy. But Marwan, you've bought, sold. What advice would you give to someone in the room looking at selling?
I think just have some realistic expectations about what the business is worth and or what the market will pay for it at a given time. And I think there are times where it might not be just the right time or place to sell that business because you're not going to achieve the objective that you want to achieve. And in that case, you just need to continue to run it and build it until the right time comes. I think the other thing I would say is presenting the information, the financials, in a very clear way, understandable way, and just bearing in mind that whatever is presented in IM, whatever is put forward is going to be ultimately is going to come out in the wash with the diligence and so on. So the worst thing that can happen when you're, selling a business is to kind of get a buyer interested on the wrong, basis, and then, halfway through the deal, find out that, they're not going to pay what they've said they were going to pay because the information is not supported. So just manage your expectations, I think.
I think just to add to that, I mean, plan for not selling the business. I think my experience is that many sale discussions that we start stall, or don't happen, or happen in 2 years' time, and you've got to maintain that flexibility. You can't plan to sell the business at one particular point in time. And really what Marwan said, do your homework. I mean, really thoroughly prepare the numbers. Don't just give people data. Really think through what it means and how a buyer's going to look at it.
Is this a market that lends itself to a formal process, or is it more one where, like Andy, if I had a small family-run business, and I didn't want to sell it private equity, why would I bother starting an auction? Or Dustin, what do you think? Would you bother, or would you just say, let's chat to Andy? Well, and Andy obviously doesn't want an auction, so he's like,
there's going to be an Act 3 for every business, right? At some point, you're going to leave it. So whether it's to an external seller or shut it down, as was mentioned earlier, or something done internally, and to the point of seller advice, I mean, the buyer is looking at two things: the attractiveness and the readiness of the business and the individual, right? So is the business attractive? Is it generating cash? Is it in a growth market? Is the business ready? In other words, is there a succession plan in place that will outlast the owner? And finally, is the owner ready? That matters, because an owner that doesn't have a plan for Act 3, those deals blow up, because their own identity is that company, what they're selling. And once they realize that that's going away, that tends to crater deals. So a buyer wants to see that there is a plan in that aspect.
Andy?
I think
in your case, just identifying which grandchild takes it.
Yeah, who shows up at Christmas? I think the original question was, what advice would we wind up giving to either sellers or acquirers? And I think my answer is going to have themes with what these guys have said, but it's probably going to be a little different depending on who's doing the buying. For anybody within the industry in the room, what I would wind up saying is, whatever your time frame is for integration. I mean, for us, it was a couple of years with each company. Double it. It never happens as quickly for a myriad of reasons. If there's people looking at investing from outside our industry, very much what Marwan said, understand what you're acquiring and understand the emotion behind your buy, because your emotion could be misleading you. You could get intoxicated by how flashy we can be, and social media and influencers, and your kids saying, Mom or Dad, look at how cool it is, all the rest of those things. It can wind up being intoxicating and as a result misleading. So really understand the economics and the business before you decide to throw money at it.
Okay, let's do a really quick round. You can do yes, no answers. Consolidation has been announced for 20 years. But it's still not here. Is there anything different now? Yes, no, Marwan?
Yes.
Okay, what's different?
I think it's what you mean by consolidation. I mean, I think in the early days, consolidation was, if you had, 900 operators in Europe, you consolidate, you end up with 20 or 30 or 40. That's not going to happen. But I think the absorption of companies by others to then kind of generate that food chain and making room at the bottom of the chain is going to happen and is happening.
Andy, is vertical integration an option? You guys have de-verticalized in the last 50 years?
Yeah, it's absolutely an option. We just have a different model, right? Where we are pure management and all other services are outsourced. So will vertical integration be an option? Yes.
Dustin, does it make sense for OEMs to own operators? Bearing in mind there's one in here that is owned by an OEM.
No. No, it may make sense. It's just difficult to do. And they're better off making the airplanes than they are operating the airplanes.
Angus, is private equity difficult to deal with valuations low?
The answer is yes, they're difficult to deal with. I think my experience, and I act for private equity and act for companies selling to private equity, they're particularly intensive in terms of their analysis. They go much deeper. So to that extent, they're harder. They're also, I would suggest, much more disciplined about value. And if there isn't always a way to cut a deal in the way that there could be if there's a peer company buying it. So be careful if you want to get into a discussion like that.
And public companies, just the same. Marwan, you love public companies.
Absolutely.
Look, there aren't public companies anymore in this particular area, and I think for very, very good reason. I mean, my particular view, because a lot of work I do is with public companies, you need to be of a very large scale to make it work, to have a stock market profile, and to bear the extra regulatory costs of being a listed company. And in Gama's case, you didn't have that scale. You didn't have the market liquidity, so you were bearing a lot of cost without any of the benefits of a listing. So it was absolutely the right thing to come off the market.
Final question, very quickly. There's probably 300 companies at this conference, 350. How many of them will merge with each other in the next year?
349 when Marwan and I are done.
And on that announcement, the drinks are down, you come out of here, turn right and walk across. Thanks so much to the panelists. Thanks to everyone today.